What's going on, everybody? My name is Handoki. I'm a commercial property agent, and today I'm going to talk about what's better, stocks or property. Let's go! Okay, so I want to talk about stocks and property. Alright, well, what do we know about each of them? Okay, well, stocks. Alright, well, I think it's fair to say that there is a lot of noise around stocks, and it's, things like GME, things like Tesla and Bitcoin, things like there's a lot of buzzword out there. I'm not here to have a big discussion about what to invest in, whether this has potential, whether that has potential. Nothing like that. I'm just going to use indices and the returns that it was able to have. And we know that a lot of YouTubers and a lot of people, mentors, people who've been kicking ass in investing, well, they've said that to actually safely park your money, the best way to do that is in the indices. Indices, the US 500, they always have consistently generated 10-12% a year, and that's pretty good. That's money in, money out situation, and that's all good. So that's sort of how much it's returning. So let's assume that stocks, they will always consistently return, let's say 10% every year, and that sounds pretty good. Whilst the properties, well, they go up hopefully 10% a year on capital, or maybe on yield or whatever, and you can yield about 6 to 7, 8%, whatever. You've seen some of my previous videos, and that's sort of how much they yield. Great, that's how it happens, but then it doesn't look as sexy as your investment in stocks might be. But let's actually dig into the numbers and see what is actually available. So let's go. We've got stocks that generate 10% a year. If you spend $100,000, then you're going to get $10,000 back. Well, but not as a way of cash flow. It just builds your capital unless you cash out that amount of money every year, in which case there's no really compounding effect, which is what stocks are genuinely useful for. Now, I vouch for cash flow. So, if you're young, even if you're old, look, if you're asset rich and it's not doing anything for you and you're not generating cash flow, then you are poor. You don't have a cash flow. You're asset rich, and that's a lot worse than being cash flow rich. You'd rather be cash flow rich. So you got stocks that build up in value, but at 10% every year. But the thing is that generates what? That's on 100K, that's about 10 grand that you're getting back. Or in the alternative, let's say we've got a property that generates, let's say 7 or 8% a year. Now, commercial properties can do that. Some residential properties can actually do that, depending on where you find them. But for you to do that, you need to make sure that you're picking the right properties, and I will make a video about how you actually do that soon as well. But let's say there's a property that generates about 8%, and you also spend about 100K buying that property. Let's say the LVR on that is about 80%, which means that loan to value ratio, the loan that you're going to make out of the 100K is 80%, which means you're borrowing 80K to buy that 100K home. All right. Are there $100,000 homes? No, that's not what I'm debating. I'm just saying that in this example, the house is $100,000. All right, and then that generating 8%, you're going to get $8,000 a year coming back. Okay, great. That means how much money did you put down? 20 grand in that investment, and you borrowed 80%, which means you borrowed 80 grand, and then with that 80 grand, right, you're going to have to pay a loan repayment on that, which at the moment is around 2.5%. So let's say the 2% of the 80 grand is 1.6 grand, right? 1.6 grand. Let's say you pay 2 grand just because you're cool. You want to pay off some principal. Maybe you got a bad deal, and so now you have to pay a bit more on the interest rates. But let's say that's the amount of money that you're paying, because that's the price of money these days, right? That rate is what property investors are paying out there. Okay, great. So you're paying $2,000 out of that 8 grand that you generate in rental, right? And then from there, what you're going to do is you are going to end up with $6,000, right? So what was the gross investment that you made into this property that you bought? Well, you bought it for 20 grand. You put down 20 grand, you are getting back 8 grand, and then you owe the bank 2 grand every year. So that 2 grand is going to go out, and you're making 6 grand back. Okay, now you invested 20 grand, but you're getting 6 grand back. Now, what is that in percentage? Well, that's about 30% return, if my math isn't wrong. That's right, that's 30% quick maths gross return that you're going to make on the equity that you're making, that you've put down, right? Versus the 100K that needs to go in to make that 10 grand back. What's better? That's 10%, and this one, on the actual money that goes out of your pocket for the investment, you're going to get 30% back. I think that's why properties always win. How many billionaires are there, right, that have gotten there through stocks? Versus how many billionaires are there that they've gotten there through property? Well, my understanding is that 90% or whatever, some crazy high percentage of billionaires have actually gotten there because of property. So what does that mean? Well, whilst your stocks, you may have your crazy wins, like your Bitcoins and things like that, but that's highly speculative. Now, whereas like the properties, you are going to yield much higher because you're going to borrow the rest. And that sweet thing is called leverage. Boom. That's right. So leverage is the key here. So if you're able to leverage things, you can do that. People might now start comment and say, well, Hundo, you know, you can get leverage on stocks as well. Yes, you can. And I've been down that road. It's called CFD, this and that, Robinhood, blah, 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 blah. But the thing is, that again, you know, as a high amount of risk. And so if you leverage that much, like 5 times the amount, if the stock shook down that level and it actually hit your margin, you can actually exit your position straight out of it, which can be extremely dangerous. So that is something that you need to keep in mind, and adding that risk factor into it, it almost becomes not as worth it. So, and that's also highly speculative. Whereas in this alternative, in the property section, you're getting rent, which is an actual commitment every year, a legally binding contract that says, I will pay you this much money for your property, to live in it, to run my business in it. And to me, that is a much more reliable source of income and to set up my cash flow, which is probably why the banks are willing to lend you that much money for it and to risk that project with you, to actually allow you to invest in your properties. So there you have it, guys. That's property versus stocks. And to me, I will always go for property, unless you had cash that you weren't actively investing in property and you're just sort of in the process of generating enough cash to make a down payment for your next one, and you're not particularly using that cash for your existing properties on your portfolio to actually improve your tenancies, or whether it be a home or a commercial tenancy, then that money could easily go into that stock portfolio there, which is, you know, like your indices that could grow at 10% a year. But the problem with that is that when you have a day that you actually want to pull that out and you want to actually invest into properties, well then you got to get that out of there. Point is, it's always opportunity based. If you've got good opportunities in stocks and you're very convinced for it, well, go for it. And if you think you've got good opportunities in property, well, then go for that as well. So yeah, I'm sure I'll be making more videos about stocks and property later down the track. So please stay tuned. Please smash the like button, subscribe, and share this video. And I will speak to you soon.